Hey, welcome back to Compounding Quietly. Most investors don't build a complicated portfolio on purpose. They build it one reasonable decision at a time. A broad fund first, then an income fund to smooth out the volatility, then a sector tilt because something looked interesting, then a hedged position to offset what the sector tilt exposed. And somewhere in there, the original clarity disappears. What starts as a plan becomes a collection, and most people don't realize there is a structure that avoids all of that from the beginning. Let's look at what most investors quietly walk past. The 3 ETF portfolio is not a new concept. It has been discussed in long-term investing communities for years. But knowing about something and trusting it are two different things. Most investors who encounter the 3 ETF idea acknowledge it and then move on, because it feels incomplete. When you are reading about dynamic allocation, factor tilts, and yield optimization, holding 3 funds feels like you skipped something. That feeling is worth examining, because that feeling, not the strategy, is usually where the problem starts. There is a documented psychological tendency in investing, where complexity signals competence. The more positions you manage, the more it appears you have done your research. But research volume and portfolio quality are not the same thing. A 12 ETF portfolio often carries significant overlap between positions. 2 ETFs covering the same large-cap growth stocks, another partially replicating what a broad index already holds. The investor thinks they are diversified. What they actually have is concentrated exposure to the same underlying companies, held across multiple tickers with multiple fee structures. Complexity does not reduce risk by default. It often just adds cost and confusion while appearing responsible. The 3 ETF structure addresses this at the source, not by aiming for minimalism as a goal, by demanding that every position earns its place through a distinct, non-overlapping job. When each ETF is doing something the others cannot, there is no redundancy and no gap. The portfolio is complete. And you know it is complete because you can explain it in 3 sentences. Here is what that structure looks like in practice. The first ETF is your foundation. A low-cost, broad market index fund, something like VOO or IVV, gives you exposure to the largest publicly traded companies in the world at a very low cost. This is not an exciting position. That is intentional. The foundation is not designed to outperform. It is designed to track the long-term direction of the market, compound quietly, and require no active management. Think about what this position provides during a market correction. In 2022, the broad market declined significantly over the course of the year. Investors who held a broad index fund and understood what they owned had a clearer path forward. They knew the underlying companies were still generating revenue. They knew the dividend payments from those companies were still flowing. They knew that every previous downturn in modern market history had eventually recovered. That knowledge did not eliminate discomfort. Market drops are always uncomfortable, but it transformed the potentially irrational decision into a manageable one. The Foundation ETF is not just a return vehicle. It is a clarity vehicle. It tells you what you own when the market gives you a reason to doubt it. The second ETF brings income. A dividend growth ETF, such as SCHD or VIG, adds a yield component that compounds parallel to price appreciation. Most investors misread this position when they first encounter it. They see the current yield and compare it to what a savings account or a bond is offering. That comparison misses the mechanism entirely. The current yield is not the value proposition. The growth of that yield over time is a dividend stream that grows 8 to 10% annually, will double your income in roughly 7 to 8 years without deploying a single additional dollar. You are not just holding an asset that appreciates. You are running a compounding income engine alongside a compounding price engine. Both are growing simultaneously. Most investors watch only the price. The income growth is the part that changes the math over a long horizon. Here is a scenario that illustrates this precisely. An investor begins holding a dividend growth ETF when the current yield is around 3%. Not impressive at first glance, but they hold it consistently for 6 or 7 years. Over that period, the dividend per share grows as the underlying companies raise their payouts. The ETF passes those increases through, and the investors' yield on cost, the dividend, calculated against what they originally paid, is now meaningfully higher than that initial 3%. The share price has moved as well. Both streams have grown, Neither required active management. This investor did not time the market or rotate between strategies. They understood the structure and held it. That is the outcome the second ETF is built to produce. The third ETF is where the individual decision enters the structure. This position extends the portfolio into territory the first two do not reach. Some investors choose an international equity ETF, adding broad exposure to markets outside the U.S. and reducing the geographic concentration that comes with holding only domestic funds. Others choose a growth-oriented fund, like QQQM, adding heavier weight to technology and high-growth sectors that are underrepresented in a standard, broad market index. Neither is universally correct. What matters is not which one you choose. What matters is that the choice is deliberate. The third ETF answers one question. What part of the global market am I not reaching with the first two positions? When you can answer that clearly, the selection becomes straightforward. This is why the 3 ETF portfolio is the most overlooked structure, not because it is hard to find, because it is hard to trust. It resists the urge to add positions, to optimize continuously, to respond to every market development with a new holding. And that resistance feels uncomfortable. It feels like you are not doing enough. But doing enough and doing more are not the same thing in long-term investing. Coming back to the question raised at the start, why do most investors walk past this structure? They walk past it at the exact moment it looks too simple, and they build complexity to replace a feeling they misread as a gap. The gap was never in the portfolio. It was in the clarity. 3 ETFs with clear, non-overlapping jobs form a complete strategy. 10 ETFs with overlapping exposure form a complicated habit. The 3 ETF investor does not spend significant time rebalancing positions each week. They confirm each ETF is still performing its intended role. They add capital on schedule, and they wait for compounding to do what it is designed to do. That waiting is not passivity. It is the strategy. One of the most persistent investor mistakes is treating activity as a proxy for progress. More trades, more tickers, more research cycles, it feels like doing the work. But for an income-oriented long-term investor, most of that activity is friction. Friction costs money. Friction costs attention. And friction interrupts compounding at the worst possible times. If you are currently holding more ETFs than you can clearly explain, that is worth pausing on. Not as a reason to sell everything immediately. As a question, does each position here have a defined job? If the answer is yes, the position belongs. If the answer is uncertain, the position is likely creating noise you are paying fees to maintain. You don't need more positions to build a complete portfolio. You need clearer reasons for the positions you already hold. 3 ETFs with distinct, well-understood roles will compound more reliably than 10 ETFs. You're hoping will work together. Not because 3 is a magic number, because clarity is what makes compounding work over time. The structure isn't the limitation. The structure is the point. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.